Thank you, buddy. Hiya, Mark.
Good morning.
Happy New Year, buddy.
Happy New Year. Hope this one's a good one for you.
You too, but and not just in the market, in every way for you and your
Yes.
family. Okay, so did you want to share your screen, or do you want me to be just showing the markets we're talking about?
Maybe, can you see this if I put this up on my screen now?
You hit the green share button. You'll see it's on the drop-down menu. It's a green box.
Okay, let's see. I think this one will do it for us then. Let's see.
Yeah.
Yep, okay. So maybe just introduce this. So as some of you know, I've been following the foreign exchange market. Dale, I might be close to your age. I think that our paths crossed at the floor of the Chicago Merc back in the mid-'80s.
Yeah, I'm 66 now.
I was born in '61.
Oh, you see, you're just a punk.
Little kid to you.
But yeah, our paths did cross, and I've been following your work. I've read your books, Mark, and I've interviewed you for years. And what a great time of the year to get an assessment of what your views are, and with all these different cross currents happening, geo and overnight Fed funds rate, and what's happening now with a new ECB chairman. So tell us what's on your radar, buddy.
Yeah, so I want to show you this chart because I think that a lot of times I find there's a big difference. I began my career on the retail side and I moved over to the institutional side, and I think there's a big difference. And it's not just access to information or access to deeper pools of capital, but it's also how we go about thinking about things and the tools we use. And so while we always are trading individual currency pairs like dollar-euro or euro-NAKI, like you were just talking about, the way to understand it from a policy-making point of view and from an impact point of view is this chart I have for you here. This is the Federal Reserves. You can see on the top of it. It's a trade-weighted, real, which means it's adjusted for inflation, and it's broad, meaning it includes the bulk of U.S. trading partners. And I call this chart up because this is my roadmap.
Okay.
This is a picture of how the dollar is performed on real, adjusted for inflation against major trading partners since we went off of Bretton Woods back in the early '70s. And you can see how we've had these three rallies. As clear as the nose on my face, three big bounces. Right. And the first one we associate, so you can see that in the beginning of the '80s. And that's the Reagan rally, Reagan-Volcker rally. Fiscal policy was expanding with tax cuts, social spending, defense spending, and Paul Volcker, as you know, was stamping on the brake of monetary policy. And that policy mix, tight monetary policy, loose fiscal policy, is the best policy mix for a currency. We get the Reagan-Volcker dollar rally. And then at the Plaza Hotel in 1985, G7 agreed the dollar had gone too far and intervened and drove it down. The dollar entered a 10-year bear market, and then we had the Clinton-Rubin dollar rally. And this is the high-tech bubble in the U.S., I should say the first one. Okay. And it was also Robert Rubin coming with the Treasury and announcing a strong dollar policy. And I see, we still make fun of what the strong dollar policy means. And I always joke that, we had a vice president who once said that a strong dollar policy meant that the dollar was difficult to counterfeit. It had nothing to do with its exchange rate.
Huh. Who was that?
I also think the strong dollar policy meant is that at least from Rubin, until we could argue about these last couple of years, but from Rubin on, the U.S. has not used the dollar as a weapon. And that's what happened in '87 with the stock market crash. Yeah. Some people associate with James Baker at the Treasury threatening to let the dollar fall if Germany didn't stimulate its economy. And then this big low we had in mid-90s was when Lloyd Bentsen tried the same game on Japan, saying if Japan didn't, I think it was ease up on its auto trade with the U.S., that Lloyd Bentsen, would let the dollar fall. And so when Robert Rubin came in, he said, no, the U.S., the strong dollar meant that the U.S., would not purposely devalue the dollar to gain trade advantage or to reduce our debt burden. The market believed him. We went on a 10-year, roughly, bull market for the dollar. This is the Clinton-Rubin dollar rally. And then in October of 2000, Lawrence Summers was the Treasury Secretary at the time. And while we're buying Lucent and I remember Netscape as the IPO in this era.
Yeah.
And while we Americans kept our money at home, foreigners could not buy enough of U.S. equities. But Europe gave birth to the euro in these years and thought we were picking on the euro. And so they organized the intervention, which Summers, the U.S., participated in October of 2000, and drove the dollar down, drove the euro up. We went through another 10-year bear market for the dollar. And in the middle of the financial crisis, I think that the dollar bottomed and has begun rallying. And for me, the question is where we are now with this Obama-Trump dollar rally. I have been arguing since around the middle of last year that this dollar rally is about over. Maybe we can make a marginal new high, but I kind of think that we're rolling over. And in the period ahead of us, we should be looking for the dollar to weaken on this broad basis. Now, what's interesting about this, if I could stick this up here while we're watching it, is so I've got to use Bloomberg charts, but okay. I'm going to lay the euro over this. And I'm just going to take the inversion of the euro just because it's easier to do this. And there you can see how, even though the white line is that broad-based real trade dollar index, you can see how the euro, which is really Europe, is really the biggest U.S. trading partner as a whole. You can see how well the euro tracks this real broad trade-weighted dollar. Yes. So by being bearish on this broad trade-weighted dollar, it gives me insight that the euro is likely to get stronger. That is, as this is moving down, the dollar is getting weaker. Right. So this is my big framework. And some people say, well, why should the dollar get weaker? It's a key reserve currency. Europe's got negative interest rates. There's a whole song and dance about why, after many people have only experienced this bull market for the dollar for the last decade, they say the dollar can't fall.
So it takes 10 years for people to get amnesia, huh, Mark? That's the way it seems here.
That's the way it seems. And I think that it's true, too. I think, and I see this among short-term traders, is that the way we make money, we sort of get into this rut, buying dips or selling rallies or using this indicator or that indicator. And we're reluctant to give up our cash register, even though the markets may change. And so I think what happens is the markets change. And over time, we have to change our cash register or find a new job. And I think that that's where the market's at right now. I think we're at some crossroads. And here's an interest. So why do I think the dollar is going to come off? Maybe I can address that. Let me see if I can call up another chart here. Let's see. You said go back
also,
to that.
Mark, after the financial crisis, the beginning part of it, we had about a 30% depreciation of the dollar and about a 30% rally in S&Ps off the lows, and it's my contention it was nominal. Isn't the dollar the perfect sacrificial lamb right now for central planners to perhaps keep other asset prices up?
Yeah, no, I hear you, Dale, and I think that
noticing. Go ahead.
Yeah, I think that I'm really pulled here because there's two ways to go here. One is that the secret cabal, if you will, this plunge, whatever the
the PPT,
the zero hedges of the world, like to think that there's a committee that really runs everything, and I kind of much more influenced by the Wizard of Oz. When you pull the curtain, there's nothing there. The wizard's a fraud. The central bankers, they might try to be planners. GM has a 5-year plan. Ford has a 5-year plan. Surely the government should have a 5-year plan. No one doubts about planning. I think the contribution of capitalism is decentralized planning, but the planners are not in control. I don't think that if they were in control, we would see these economic data that we've been seeing. They would like stronger growth.
Yeah.
They would like higher inflation.
Good point.
They would like lower. I just don't. So I know that there's this conspiracy theory out there that officials are really getting what they want here. I think that they are having to write the playbook as they play the game. And so I don't have the confidence that.
It reminds me of man plans and God laughs.
Yeah, I saw this funny cartoon along those lines. It had a guy carrying a sign that said, "The end is nigh. The end is nigh." And someone says to him, "Why are you so optimistic? This could last forever."
And it has so far.
And so And so for me, I'd say that the great financial crisis came as a big surprise, as a shock, and since then things have changed. So, for example, previously you're talking about how the central banks what they were doing with the Fed's balance sheet, and
Yeah.
of course, but they went into it with expanding it. They said it won't last very long. But we're finding that there's other things that have changed, like the demand for reserves, like the regulatory burden. So I don't think that Bernanke lied or Yellen lied. I think that the questions changed, the context changed. And I think that officials, for the most part, are true believers. I don't think that Bernanke went out of his way to mislead the market. Okay. I don't think Yellen does.
It's the invisible hand that's really running the show.
Yeah, but even that, I think that's like so confusing what the invisible hand is sometimes, you know?
The market, people voting with their wallets.
Yeah, but it's only some people. So, for example, thinking about what the euro is going to do this year, you look at the futures market, and you'll see that the net position of speculators, our net position is short euros. But if you look at the bank's forecasts, you look at economists' forecasts, you look at analysts' forecasts, and they all have a stronger euro next year. And so it depends on like voting and like short-term traders, longer-term traders, and different influences. So I think the dollar is turning, but I'm not going to be convinced that we get a very sharp move. I think you might have been talking about like 20% or something like that. I'm thinking that and this is why I love the currencies. Besides being the biggest of the capital markets, $6.6 trillion a day, you have to battle wits with all the players, central bankers, governments, hedge funds, asset managers like mutual funds, insurance companies, speculators, artificial intelligence. That's why I've always, even though I've been on this institutional side, my hat really goes off to people who have to eat what they hunt. Small speculators who are using their own money, not using other people's money, to try to battle wits. And so for me, it's a hard game, and that's why I've always had respect for those who live on their own hunting. And so I try to help by just identifying some of these fundamental forces. And the reason I have turned on the dollar after being bullish, my first book called Making Sense of the Dollar came out in 2009. It came out in August of 2009. And so you could appreciate it was in the heart of the financial crisis.
Right.
And I anticipated a long-term dollar rally. And I think that rally is over. And partly I look at the reasons that I think really fueled the bull market. First was the policy mix. The U.S. had a relatively tighter monetary policy, a loose fiscal policy. This is bullish for a currency. That policy mix is the opposite now. The Fed has eased policy the last 3 moves, and I think the next move is going to be another rate cut. I'm a little bit out of consensus here. I think there are going to be 2 rate cuts this year. Something like 14 of the 17 Fed officials say no cut will be necessary. After that week ISM before the weekend, the market is pricing in about an 80% chance of 1 cut. I think there'll be 2 cuts because I think the U.S. economy is losing momentum, and I think that it's hard to say that high-frequency data is important in the big picture, but I do think they can illustrate some themes, and I think they're going to see that with the non-farm payrolls this week. I'm looking for something around 160,000. I think that if you look at the 12-month moving average, it's steadily falling, and this is just a cyclical indicator. So we had a long but generally soft expansion, and I think that expansion is vulnerable, and I think that expansion is vulnerable in particular to the tightening of monetary policy. The loosening of monetary policy, the tightening of fiscal policy under the rubric of those tariffs. Okay. And I think the economy is slowing. And so for me, the policy mix is no longer supportive. And second thing, can you see this chart I stuck up here? This is the U.S. German 2-year yield. Can you see that? Or do you still have the dollar?
No, I still have the real broad dollar, so I don't have the 2-year yield yet.
How do I get back to that?
You could stop. Okay, it just came up. You got it.
It just came up?
Oh, it came up, then it went away. So
let me try it again.
Okay. There it is.
There, you got it?
Yeah. But when you try and don't try and increase the size of the window. It's big enough we could see it, because when you try and make it a full page, it goes away. So Leave
You
it
can
up,
see it.
click it just at one time.
Yep, you can see it
Okay,
now?
leave it. Yeah, we see
Yep.
it.
Okay,
Yep.
so this is the amazing thing here on this chart. This is looking at the 2-year interest rate differential between the US and Germany. And you can see, I don't have it going back that far, but from 2015, we were about 50 basis points. We got up to 350 basis points at the end of 2018.
Yeah.
Look at the direction it's been moving, despite Europe having negative interest rates, despite the ECB easing. Look at what's happened. That interest rate differential has moved against the US all of last year.
Yeah.
All of last year from 350, so call it 215 today, but we call it 220 end of the year or something like that.
Okay.
And so for me, the 3 legs of the dollar's rally was, one, interest rate differentials were moving in the US's favor. Now they're not.
Okay.
And I find that on the retail level, many people think in very linear terms. What level of interest rates equals some level of the euro-dollar exchange rate? But I think that what you'd find is that the more like sophisticated or complex models are not so linear but cyclical. And so for me, I find that the last phase of a big dollar rally takes place as interest rate differentials are moving against it. It is as if the market is saying, we don't need such a good return on the asset because we have the dollar at our back.
Right.
And it worked.
Right.
And it works
We
until
didn't
it
need the
doesn't.
yield because the currency was
Because the currency compensates.
paying. It was
Exactly.
paying them. Yes.
Exactly.
Okay.
And that's what investors want, huh? They want,
Yeah.
what we're really interested in is the total return.
Right.
Interest, capital gains, currency gains on those foreign assets.
Right.
And so this doesn't only work for the for Germany. It also, this lines up very well for the UK, lines up very well for Japan as well. Interest rate, so the 2 legs of the dollar's rally, the policy mix no longer as supportive, interest rate differentials no longer as supportive. Now, when it comes to equities, everybody's got an idea what valuation is. Free cash flow, you look at PE ratios, you look at replacement costs, all kinds of different but generally agreed upon models. In foreign exchange, the closest thing we have is something like purchasing power parity. And here's what it's like. I was watching this the mixed martial arts fights. My wife wasn't home one night. I was watching these fights, and what else are we going to do, right? And they said that this one guy who's smaller than me, he was supposed to be a lightweight, and they said pound for pound, he was the strongest man there was in the fighting. And pound for pound, that's what purchasing power parity is. It's like pound for pound. If China was pound for pound as big as the US, the RMB would be stronger, for example, or whatever the rule is. And so the idea is that it's not that small guy, that mixed martial artist fighter, he was not stronger than the big guy, but if he weighed as much as the big guy would, sort of like an ant, an ant can lift 100 times its weight. Most of us humans, we're lucky if we can lift one times our weight. It doesn't mean an ant is really stronger than us.
Especially now. Anyway, yeah, go ahead, buddy.
But it's not like an ant is stronger than us, even though it can lift 100 times its weight, but pound for pound it is. And so I'm just trying to get to the idea that—
Great metaphor, really.
Yeah, purchasing power parity has to be, it's a tool that shouldn't be misused. If you're that small fighter, you're not going to go up and beat up and try to pick a fight with a big guy just because you're pound for pound, you're stronger than him. Same thing in the currency. So valuation, this is one area where I think President Trump is spot on. The dollar, by almost any measure of purchasing power parity or some of its derivatives, cousins, if you will, they all show that the dollar is overvalued. And here's the interesting thing. Everybody's got their own model for it. I rather than reinvent the wheel, I'll just use the OECD's. And typically, the OECD currencies, these are the major currencies, Organization of Economic Cooperation and Development, they have their own purchasing power parity index. And they're a rubber band that connects spot to the value, or value to the exchange rate. How far it can move away from purchasing power parity? Usually 20 to 25%. The euro is about 24% undervalued. So
Interesting.
we've lost the policy mix, interest rate differentials. The trajectory is moving against the U.S. and the dollar's overvalued by about as much as it gets against, say, the euro, the number one currency outside the dollar. So those 3 reasons, I think the dollar is rolling over. And then what I try to do is play in the short term. What does this mean the clients at
As far as magnitude, everyone wants to know,
yeah,
well, okay, where could the euro go to, Mark? Right?
exactly, exactly. I think that people play the magnitude, but here's the interesting thing I find is that the market. This again, I like the market because of the diverse participation. And so I've spent my career helping the S&P 500 corporations, the largest asset managers. But I kind of thought that because of artificial intelligence, the rise of indexing, a macro guy like me wasn't adding as much value as I think I could to that part of the market. But they're not the whole market. These days, I'm helping small and medium-sized corporations at Bannockburn Global. And here's what it means, is that these large asset managers, maybe you should think about this for some of you are trading, thinking about the kind of spread that you pay between the bid and the offer. The large asset managers, the large corporations, on the euro, right, they're going to pay a thousandth of a penny spread between the bid and the offer. It's not just the 4 digits, but it's the 5th digit.
Yeah.
On the other side of the decimal point. Now, many small, medium-sized corporations are paying sometimes 3 to 4% spread between the bid and the offer. Now, I know for you traders, you're not paying that spread, 3 to 4%, but the spread is incredibly small, and just like in the rest of our lives, and that's what I like about what you do, Dale, is I think that you try to keep the trading and the markets within the context as a holistic approach, as who we are as people, what other things are going on. And the context, I think, is that the small pool of capital is always at a disadvantage. It's like watching those poker shows on TV. The small stack is at a disadvantage. And so I find I can help those small, medium-sized businesses who are paying very wide spread between bid and the offer and bring institutional knowledge to them. And it's sort of like in other parts of our life, we know when we buy something at a store, we're paying retail for it. And a lot of people, I don't think, appreciate that money works the same way. There's a wholesale price for money and a retail price for money. And if you don't know the difference, you're probably paying the retail.
Yeah. So, I mean, just that alone, that cost. So controlling of costs is an important thing that you're educating medium-sized, small-sized businesses with, because, you have to, if they have to hedge 4 or 5 times a year, that's a lot of money.
It's a lot of money. And so I think that the efficiency, market efficiency, and also what's the conclusion of all these indexing funds and all these asset managers? They do this trade cost analysis. When is the best time to trade? Well, it turns out the best time to trade is when everybody else is trading, which is basically the European afternoon, the U.S. morning. That's the most liquid part of the market. And that's when the spread, say, between the euro and the euro-dollar exchange rate gets the narrowest. As you go outside of the prime areas, the spreads can get wider. And this is especially true for those regional currencies, whether East Asia or even, you were talking before about euro NOK, dollar NOK, and even, I like Norway. I think Norway is, when I'm bullish on Europe, I get even more bullish on Norway. I think the macro fundamentals, very supportive. It's attractively priced currency. Part of the problem, though, is that it's not a deep market because there's not a lot of assets in Norway people want to buy. You have maybe an oil company, a couple of other companies, but for the most part,
yeah, they do the buying. Don't they have one of the largest sovereign wealth funds on the planet?
Exactly, and so every month the gain there is not what's going on in Norway, or like you say about. I think before, I think it was Steve was saying about how Canada's had some weak economic data. Yes, of course it's had some weak economic data. So has Japan, and look at Japan, 4-month highs on the yen today, and it's not because of the Japanese economy. It's because of how the yen fits into the world economy. I'd say the same thing partly about Canada. Canada is the only country right now that's got a major country that's got the 2-year yield above the U.S. 2-year yield.
Interesting.
That affects like forwards, which affects corporations, which affects hedging. I think it should affect how we think about things. For me, it's a waterfalls. Canada is the first. But over time, that's why I'm bullish on the euro. I'm not over the top bullish the euro. I think my year-end forecast is around 115 or 116 for the euro. It's not a big move, but it's the direction. And I'm waiting for better news from Europe. We had some decent PMI this morning, confirmation of the flash, more or less, a little bit more than the flash. But German manufacturing sector is still contracting. They've had some weak numbers, export numbers. Italy's poor, and so I'm really waiting for some better European news to gain some traction.
You know what we're waiting for, Mark, and I want to comment on yours from you. More volatility. We're at record low volatility in many of these currencies. Last year, one of the lowest vol readings in euro and other currencies. Do you see that continuing, or is there a possibility that as the dollar rolls over, vol picks up?
Yeah, no, that's how I think about it, Dale. Is volatility. I agree with you. It's low, but I know I know a lot of people who think it's and in short period of time I often use the phrase too, like being compressed, like a spring coiling.
Yeah.
But it hasn't done that.
Yeah.
It changes characteristic. And I do
it's
think
a string. It's like a slinky that's lost its spring.
yeah, huh? It's like stuck on that stair, huh?
Yeah.
And so I do think what do we need to see for volatility to pick up? We need to see it move out of this range that we've been in, say in the euro, call it 110, 112.
Yeah.
109, 112, something like that. We need to break out of that. That's why I thought that's what the yen is telling us. Or even sterling, when we got up to 135 on those exit polls, when it was clear that the Tories were going to get that majority, volatility jumped. And I think the dollar yen broke below 108 or below 108.50 or 108.30, whatever the key level was up there. That volatility has also picked up. So for me, so we think about volatility as a separate characteristic of the market, but I do think it's so directional, like the VIX. You tell me the S&Ps are gonna gap lower today, or about to gap lower, and I'd say, well, we're going to see a jump up in the VIX. And so once we get outside the recent range, that's what I think gets the volatility going.
Okay. All right.
And it's directional. So a stronger euro for me right now probably will mean higher volatility in the currencies, but not the way it used to be. I think we're in a new paradigm of relatively low volatility in the capital markets, higher volatility in the underlying economies.
Anything on the geo front that comes into the mix for you?
Yeah, a couple of things. One is the markets, I think, always exaggerate geopolitical news, partly because many of us fancy ourselves to be either trained economists as undergraduates or graduates, or self-trained by the markets, so that they're the college of hard knocks. But a lot of us,
or how about Nostra Pinkert? Can you see ourselves as a seer? Only a lot of times I get seared with my predictions. But what are you thinking, Mark? We're overblowing this. To me, it feels like we crossed the Rubicon a little bit with Iran here. So
yeah, no, I think there's so many times that I think we've crossed the Rubicon, and I mean,
it doesn't exist. We built a bridge on the Rubicon, then, huh?
Yeah, isn't that what happened? Do you remember when the Saudis' oil facility was attacked?
Oh yeah.
Now this was a watershed.
Yeah.
Saudi homeland was being attacked, and so I kind of think that that the geopolitics is a mess, and it's not just Iran. Right now, Iran and Iraq. It's North Korea.
Yeah.
It's Libya Turkey going into Libya. It is. It's what's going on in Venezuela today or last night. So I think that the world's a mess right now.
Yeah.
And
how about trade, Mark? Are you optimistic? I mean, phase one, does it mean anything to you? I remember last interview you said we're already in a cold war with China. That continues?
I still think we're in a cold war with China. What's funny is these days I'm beginning to read a little bit more of the South Morning China Post. And they have an interesting article in there today claiming that the Chinese were caught off guard when Trump went ahead with saying that they're going to sign this on January 15th. They hadn't even planned on coming here then. And that President Xi that Trump would go ahead of this, make a unilateral announcement, and even if President Xi wasn't available. And so it just tells me that the two sides, they might be talking every day or every other day, or whatever the spin is. But
they're on different pages.
They're on different pages, and it's like having two people are talking. Maybe it's the U.S. and the U.K. talk the same language, but they don't understand what each other is saying. And so I do think that this disengagement with China is going to continue. I think that we're going to be monitoring the trade flows, of course, seeing if they can make good on the $200 billion increase over the next couple of years. It sounds really important, but at the end of the day, I think that both sides are really like girding for a more sustained conflict. I think that China will see this with their CPI later this week. So they'll report a high CPI number, and take a look at the food. Food component is really what's lifting it, and there's a shortage of protein, and so a shortage of animal protein, pork and soy.
Yeah, right.
And so as they import more, the price can ease a little bit, and I think it's important to see that the PBOC eased over the New Year's,
right,
and it goes into effect today, and that despite the high inflation, because they can look past the high inflation on the headline level and really see the underlying inflation and PPI, the producer prices. The real threat in China is deflationary, not inflationary, despite this food prices. And the same thing with oil in the U.S. I point that out, really, a distinction here is in the U.S., we typically view higher oil prices as not inflationary. That's why the Fed spends so much time talking about core inflation.
Okay.
Higher oil prices means that the more it takes to heat your house, the more it takes
money you have.
Yes, less money you have for everything else.
Yeah.
So it's a relative price change, not a general price change. And for me, it's another one of those developments that fit into my sort of not recessionary, but weak growth this year in the U.S. Recessions in the U.S. tend to be preceded by an oil spike. And I think that's what's underway now.
Okay. What a great way to start the year, Marc. I wish you a great 2020, and that your work helps businesses that are trying to compete globally in this very challenging environment. I know that you'll give them an edge, and appreciate you being here and edifying us today, my trading warrior brother.
Thank you, and good luck, and good luck with your health.
Thank you so much, Marc. Everyone, that's Marc Chandler. You could follow him at Marc Making Sense. Do you have a website now, Marc?
Yeah, my website is, yeah, sure. It's my blog is Marc to Market.
Marc to Market.
Marc with a C.
Okay. All right, Marc. Well, Happy New Year, buddy. And really, I learned from you today. Thank you so much.
Thank you. Good luck to everybody.
Thank you, Marc. All right, that's a wrap for us today, guys. See everyone for Turnaround Tuesday. Don't just count your pips, count your blessings. We'll see what happens coming in for tomorrow. And looks like metals are coming off a bit here. And I really concur with Marc. We talked about it technically, and he certainly built a case fundamentally for us looking to buy dips in euro. So adios, everyone. See you tomorrow. Good hunting.